thank you everyone for joining us this morning, afternoon, depending on where you are. I'm Diana Eidenschenk. I am the president of ACE Mentor Program of America. And many of you attended the regional meetings this summer, and you heard that we were planning this. And one of the motivations behind planning this is the fact that as our organization gets larger and larger, we see more students. Just so you all know, when we put together your balance sheets with ours, we are about a $15 million organization. So the insurance that we just bound is protecting $15 million. So as we get bigger and bigger, the more it becomes imperative that we are doing things correctly, that we are following the rules, that we are doing the protocols to make sure that our programs are safe. And one of the areas that we realize that we haven't spent as much time on that as we should is really the financial procedures and policies of each of you as an affiliate. Many of you raise some money, but still only have to file a 990 easy or I forget what the 990
And
thank you. I was going to say NEC, and I knew that wasn't right. But many of you have now gotten bigger that you have to do a full 990, and there's some consideration for audit and all kinds of things. So we thought we wanted to take the opportunity to do a webinar to help give you some information. No, this is step one. Step 2 and 3 will be going deeper into these things. But from a national perspective, we outsource our accounting. And we have a wonderful organization called Bookminders. And our individual accountant, Amanda Hines, you have probably seen her name when you get a check or anything from Bill.com. You see Amanda's name, and it's been great. But as we were talking about doing a webinar, they offered us the opportunity to have Amy O'Connor from their organization run this seminar. So I'm introducing Amy. Thank you, Amy, for joining us. And he's going to really go through the basics of not-for-profit accounting. I'm not sure what that noise is. What we will also ask is if you have any questions, it's easiest if you put it in the chat, but do feel free to ask your question if you have one. So with that, Amy.
Okay, I'm going to share my screen. So we're just going to do a very high level overview of what nonprofit organizations do for nonprofit financial reporting and record keeping. And this is just kind of a quick, I'm going to go through it at a pretty high level and quick pace. But if you have any questions that it would make sense to answer while I'm still on a slide, definitely put it in the chat. I know that Paulette and some others might be monitoring that, and just interrupt me, and then I can kind of address those as they come up. And then we can also do questions at the end as well. So we're going to go over some nonprofit basics, an overview of what the financials for a nonprofit looks like. We kind of do some comparisons to what you might be familiar, if you're more familiar with the for-profit world of accounting. And then we're going to have some ratios at the end that you can share with your board members or other people in your organization as like kind of key ratios that you can analyze on an ongoing basis to be able to understand what the numbers are saying to you. This is a slide that talks about what Bookminders is, and Diana already explained to you who Bookminders is, and that Amanda is your assigned accountant. She loves working with you guys, and she's shared a lot of information with me about your needs and things like that. So just the basics on a nonprofit set of financial statements and why we need financial statements. You have 4 different kind of main groups of people who are looking at a nonprofit financial statement. You have your management, and they want to see the financials and the records in order to make operational decisions. Then your board members are going to use them for also operational decisions, but strategic planning as well. Then you might have funders or grantors who need to look at your financials or reports that come from your financial records related to their grant to see how you've used their funds. And then there are auditors who are going to be looking at your financials to make sure you're in accordance with generally accepted accounting principles, which we'll refer to as GAAP. And these are the standards and rules that accountants need to follow for preparing the financial statements. And then the auditors, if you are at the level where you need an audit, will use GAAP to make sure, they'll give their opinion on your financial statements, whether or not they're in compliance with GAAP. So the gold standard would be an unqualified opinion from your audit firm. And that means that there's no qualifications, that everything is in accordance with GAAP materially. And then maybe you just deviate a little bit here or there. Maybe you use cash basis for memberships or for something small. And then they might give you a qualified opinion, which is still okay. But the qualified opinion would just highlight where you have deviated from GAAP. And then what would be really bad is an adverse opinion. And that's the type of opinion you want to avoid. And that would be a material departure from GAAP. So GAAP does require the accrual basis of accounting for nonprofit organizations. And that means that when you earn revenue, even if you don't get the cash yet, you need to record the revenue. And that also means that when you incur an expense, even though you haven't paid cash out yet, you need to record the expense. That's just a general overview of what accrual basis is. It also includes doing things like depreciation on an fixed asset. You wouldn't necessarily record the entire cost of the asset upfront as an expense. You would record that as an asset, and then you would do depreciation, which allows you to recognize that expense over the life of that asset. So if you have audited financial statements, you'll have a comment, a footnote that says your method of accounting has been prepared using the accrual basis of accounting. So there's a little bit of terminology that we're going to use interchangeably. Usually I'll say income statement and balance sheet because I think that those really tell you what I'm talking about. But if you have your financial statements audited, your income statement will be referred to as the statement of financial activities, and your balance sheet will be referred to as the statement of financial position. We don't really use retained earnings when we talk about nonprofits because that's not really what nonprofits do. They don't retain earnings. They have what's called net asset balances. So your unspent net assets is what's left over after your revenues and expenses when your net income, what that adds to. Or if it's a deficit, it takes away from your net asset balance. But your net asset balance is pretty much what's left over. And under GAAP, it does need to be classified between net assets with donor restrictions and net assets without donor restrictions. And we'll talk a little bit about that in the next few slides. A donation and contribution we'll just use interchangeably. And a restriction is a limitation on a donation. And when we talk about restrictions under nonprofit GAAP accounting, we're talking about restrictions from a donor, not from a board or from management. It's a restriction from a donor. So you'll start with the chart of accounts. This is your listing of financial statement accounts. Your general ledger accounts might be what you're more used to hearing. And when we onboard a new client, we design the chart of accounts based on what your reporting requirements are, going back to the users of your financial statements. Do you have funding sources that are going to require a grant report? What does your board want to see? So we kind of take all of that into account when we set up this chart of accounts so that we're able to easily just push of a button, create a report any given time for any of those people who need to use your financial statements. And the things, so transactions are what make up the financial statements. So individual transactions reflect the daily activity. It could be revenue, it could be expense, and we post them to the financial statements using the chart of accounts. So overall, this income statement, statement of financial activities, reflects financial performance over a specific period of time. Usually it's a month, a quarter, a year. It's revenues less your expenses, and that gives you what we call change in net assets. That's your net income for that period is your change in your net assets. So this is just a very generic example of a statement of financial activities where you have your revenue at the top, you have your expenses below, and at the bottom, you'll see that change in net assets, or what you might know as net income. If you're using QuickBooks, I think they still use the term net income in there. So we're going to talk revenue is the most difficult part of nonprofit financial record keeping. So we're going to start with revenue. We have a lot of topics to cover here. If anything's confusing or you need me to slow down, please just put a question in the chat. So we're going to talk about what is revenue to a nonprofit and how and when should revenue be recognized. So we talked before about net assets with donor restriction and net assets without donor restriction. If you've been in the nonprofit world long enough, we used to call it unrestricted, temporarily restricted, and permanently restricted. So those terms have gone away and been replaced with just these two terms. So starting with without donor restriction, your net assets without donor restriction include any contributions or revenue that you get that the donor has not put a restriction on it for how it's used or when it's used. So this would include your board designated funds. If that's something that you do where you separate out funds for board designation, you can certainly do that and you can keep it separate on your balance sheet, but it should be under the category of net assets without donor restriction. So on the other side, we have net assets with donor restriction. So these are the net results of activities related to revenue that came from donors who put a restriction on their funds. So they could be a restriction on how they use it, how you would use it, like is it for a specific program? Or it could be a restriction where they say what time frame you need to use it by, like it needs to be used by the end of the fiscal year. That would be a restriction that we need to keep track of and make sure that we satisfy that restriction so that we can keep that money. So there are two categories of revenue recognition. And when I say revenue recognition, this means when are you showing the revenue as revenue? When are you showing the contribution or the donation or the fees for service on your income statement is revenue recognition. So there are certain transactions that you recognize when you earn it, and there are certain transactions that you recognize when you're notified about it. So under the, we'll talk about all of them, but I'll start with the recognize when earned. That would include any in-kind contributions that you receive, any conditional contributions or pledges. That's a term of art that we're going to go into on the next few slides. And it will include fee for service, where you are actually performing a service for them and they are paying you for it. So they are receiving something in return for what they give you. And then the things that you recognize when you're notified would be donations, unconditional donations, contributions, and pledges, and usually grants. So for in-kind contributions, there are some specific rules under GAAP that we need to follow for including them on your financial statements. So when you receive income in the form of goods or services rather than cash, for non-cash donations of goods or assets, you would record them at the fair market value of the asset on the date that the asset was contributed. And what you would do is you would record it as revenue, but then the other side of it, you're also going to be recording the expense that it would replace. So if you receive supplies, you would have it as revenue for the fair market value on the date that you received it. So let's say that was, $300. And then at the same time, you would be recording a supplies expense for $300. So on the revenue side, you'd have it under in-kind contributions, and you might have a specific account for goods. And then it nets to zero on your net income or change in net assets. That's the purpose of having them in both places. For donated services, you need to donate, you need to record them if it meets these criteria, but if it doesn't, you would not record them at all. So you may recognize them, and you should recognize them, because it's good to have your full picture of what your support is for the year. So you should recognize donated services, but you can only do it if those services create or enhance a non-financial asset like a land, building, or if these services require special skills and are actually provided by somebody who possesses those skills, and you would need to purchase them if they were not otherwise donated. So an example of that would be legal services. Those definitely require specialized skills. And you want to make sure if it's provided by somebody who's not a legal expert, you cannot record it, but you want to make sure it's being provided by somebody who possesses that skill. And if it was something that you would have need to have hired somebody if you didn't have it donated. So that's an example of that part of it. An example of the create or enhance a non-financial asset would be something like carpentry services to install bookshelves or something like that. If somebody donated their services for that, that would qualify for recognizing it. And again, you would recognize it as revenue under in-kind contributions. Maybe you have in-kind contributions services, and then down below in the expenses, you would also be recognizing it in the related expense category. So for the legal services, it would be under legal services. And then the other item that you need to recognize as you earn it is a conditional contribution or pledge. So a contribution is something, if it's dependent on the occurrence of a future uncertain event, you have a conditional contribution. So you do not recognize that revenue or put it in your statement of activities or income statement until that barrier is overcome or the condition is substantially met or reasonably expected to be met. So a condition is not uncertain if it is reasonably expected to occur. So the barrier that we're talking about, it would be any kind of stipulation, condition, or obstacle that must be overcome or met, or that may prevent something from occurring. And usually it's a measurable performance barrier based on outcomes, milestones. So if you have a funding source that says, we will give you $10,000 if you provide free services to 200 children in this school district, something like that would be a measurable performance barrier. And once you've met that, then you are free to recognize that revenue as revenue that's yours on your income statement. Government funding and cost reimbursement contracts are often a good example of this, where the stipulations to incur eligible expenses, and there's a return or if you don't do it, you need to return it to the government. So a cost reimbursement, a lot of times you're not getting the money until after you've done the spending of it. So you've earned it once you've spent the money. So that would be a situation under accrual accounting where you would record a receivable because you've met the conditions, you've spent the money, you're going to invoice them, and you'll have an account receivable because you've earned it because you spent the money. So sometimes you'll have a grant where it says a condition for the money is that you need to provide financial statements at the end of the year. We would consider that an administrative requirement, and something like that does not rise to the level of a condition for the purposes of determining whether or not you have a conditional contribution. The uncertainty of collection for a future pledge, that's also something that we would not consider a condition. So those are a couple of things to keep in mind when you're kind of evaluating how you need to record these contributions. So fees for service, that's when you're charging a predetermined price or fixed fee. Revenue would be recognized when you perform the service, even if you don't receive the cash at that time. So let's talk about contributions. This is not this would be an unconditional contribution. So this is what you typically think of when a donor just sends you a check or gives you money at an event. It's a voluntary, unconditional, non-reciprocal transfer of cash or assets to an organization. There's a lot of words in there that are very important. So that means that the donor is receiving nothing in return for this donation that they're giving to you. So they could be general donations, pledges, where they give you a pledge where they say they're going to give you the money in advance or in the future, or it could be a grant from a foundation. So under generally accepted accounting principles, we have this Financial Accounting Standards Board statement number 116 that is specifically what states that any unconditional contributions must be recorded as revenue when the organization is notified that a promise to give has been made, not when the cash or asset is received. So this kind of gives some nonprofits a lot of grief because it's possible for you to receive like a 5-year grant, $1 million 5-year grant that's going to be 1/5 of that $1 million during each of those 5 years. But because you've been notified of it, and if there's no conditions on it, you would need to record that $1 million when you are notified of it, like today. So for budgeting purposes, it kind of makes things a little tricky. But that is a generally accepted accounting principles requirement that we do that. So sometimes it's almost nice that there's a condition to it so you can recognize it as you earn it and recognize it in the years that you're receiving the cash. But this is a requirement, and that's something you need to keep in mind when you're receiving large contributions for future periods. So I'm going to share my screen. This is a good place to talk about the IRS requirements for what you need to do when you receive a contribution. So I'm going to, let's see. I have, there we go. I thought I had the publication 1771 on the IRS website. Here it is. So what you can do is you can go to irs.gov and then search for publication 1771. And I think Paulette might be sending a PDF copy of this later, but it's good to know where it is on the IRS website because you'll see it was revised in November of 2023. Occasionally they revise it because thresholds will increase. So just to make sure you have the most recent copy of it, I always go straight to the IRS website, and it's pretty easy to find it. You could even just type in charitable contributions and it'll come up with a whole bunch of options for you to look at. So this is kind of plain language. It's on the IRS website, so it's not, 1,000% clear, but I feel like this is a really good publication to start with. If you go to page 5, it kind of, and this is geared towards the donee. So it talks about what the donee needs to do, but it also within here talks about what the organization needs to do in certain situations. So we're talking about what you need to do when you receive a contribution. I want to skip right down to number 5 here because this is really what's most important, where you really need to, there's a penalty if you do not comply with this section. So if you receive a donation and you are like at an event where you're providing a dinner or entertainment or something like that, like a fundraising event where they have, you're giving them something in return for part of the donation they're giving. So if that's the case, they call it a quid pro quo contribution, meaning there is a portion of that contribution that is a transfer of goods and services back to the donee. Then the organization is required to provide a description and a good faith estimate of the fair market value of those goods and services. And I think earlier, somewhere else on the IRS page, I think we were seeing that kicks in for you if it's $75 or more. But it's a good practice to do it for any of your donations. So just kind of make sure that's part of your policies and procedures when you're having a fundraising event where you're receiving contributions, and part of that is payment for services and goods, that you do need to provide in your thank you letter or your contemporaneous written acknowledgement of the donation. You do need to provide a description and good faith estimate of the fair market value of those goods and services. So this entire section relates to any contributions. It just is saying, again, it's geared to the donor, And it's saying that the donor needs to have a contemporaneous written acknowledgement for any single contribution valued of $250 or more. And this is where it kind of describes what the donee should be including in that contemporaneous written acknowledgement. And it says for valued over 250 or more, but it's really good practice to just be doing these with your thank you letters proactively and not wait for the donor to ask for this. I'm going to go back to the presentation. Okay, so for pledges, these are when you have a written promise to contribute cash or other assets in the future. You do need to have sufficient evidence just for your auditor and things like that. One of the things they want to be looking for is if it's short-term or long-term. And there are different requirements under GAAP on how to record that. So that's just something you need to make sure it's documented and you understand if it's long-term. We need to do a couple extra things to make sure we're recording it correctly in the current year.
Amy, real quick, there's a quick question. Can you explain the $250 minimum versus the $75?
Yes, let's go back to that.
Thanks.
Oh, I have trouble going back and forth with my two screens. Oh my gosh. Maybe I closed out of it. Is that possible? So when a donor gives $250 or more in a single contribution to an organization, that donor is required to have a contemporaneous written acknowledgement if they are going to itemize deductions on their tax return. So it's confusing, but the onus is on the donor to get that for anything over $250. But in good practice, nonprofits are going to provide that to the donor when they give the donation in the form of a thank you letter for probably all donations, even if they're not $250 or more. So I don't want you to think that you're going to get in trouble if you got a $10 donation and you didn't give a thank you note with the written substantiation, because it really is on the onus of the donor to get that from you. But I think we all agree it's good practice to just provide that up front. So these are, I think your Diana or Paulette had a example of a donation or contemporaneous written acknowledgement to use that includes all of these things. It includes the name of your organization, the amount of the monetary contribution. If you had any property that was donated, it needs to include a description of but it doesn't need to include the fair market value of the property if that's what you received. If you did not receive any goods or services, it needs to have a statement saying that no goods or services were provided. And then, like we talked about before, if they did receive goods and services, this is where you are required to disclose that to a donor. So anytime you have goods and services involved with a contribution, that's when the donee, the organization, you are then required by the IRS to provide that information to the donor. So we kind of went around this, this question. It's confusing, but the best practice is to always provide that. You may decide if you get a lot of $5, $10 donations, you may decide that, you know, we're going to look more like $100 and more. It's kind of up to the organization if you want to put a policy or procedure in place, but just know that the donor is required to have that to be able to use it if they're doing itemized deductions on their tax form. The donor is required to have something if they have donated $250 or more to you. If they came to a fundraising event and they gave you $75 or more, and there was goods and services that were given back to them, then you are required to make sure they have that information for their tax return.
There's
That answer
another
the
follow-up.
question?
Oh,
Okay.
sorry. While we're ready, yeah, thank you for going through that. Here's the next question. We put FMV on the invoice receipts for payment. Is that sufficient, or do we need to provide a separate statement on top of that?
What did they put on this?
FMV? Yeah.
Fair market
Oh,
value.
fair market
Thank
value.
you.
They put fair market value on the contemporaneous written acknowledgement.
No. So basically what they're saying is when many of our affiliates invoice individuals, so if they put the fair market value on the invoice, is that okay? Or see, I see two different things. I see invoice and receipt. So I look at invoice as something you send when you
Right.
need the payment, and receipt is after. So I would say the receipt is the one acknowledging you got the payment and you put the fair market value on it.
I would read it that way too. I am not purporting to be a tax expert. I am just reading the publication 1771. So I would, if you have a specific question to see if that like if you can get by using that and that would satisfy that requirement, I would check with your tax professional if you have one, or I don't know, Diana, maybe your auditor could help with that question.
Sorry, I was muted. Yeah, so I've already sent it to our auditor and our tax person, and we are drafting samples. So in the tools where this is being recorded, so this will be on the tools. We will also have samples for you.
That sounds good. All right.
And then some other questions, and this is like, maybe we can add this afterwards, is the question for the affiliates. How do you do fair market value for tickets to an event? Is it just the catering cost per person, or goods given, just appetizers? How do you calculate that? And then someone replied, we take the total cost of the event, divide it by the tables or foursomes. We do a banquet annually as well as a golf tournament. So yeah, I think that's
So
something that we can
I would
provide.
say
Oh,
the
go ahead.
golf
Yeah.
golf outing is probably the easier one, because usually for a golf outing, you get a per head cost. So each golfer costs so much. For the banquet, I think that's exactly what you do. You take the total costs and divide it by the number of attendees, and you can come up with your fair market value that way. But we're happy to help anyone who needs some additional help.
I might also like look at what the fair market value to that individual person is, because sometimes if you're taking the total cost, you might have other costs in there that aren't directly back to the person who's getting the dinner. Like if you want to keep that number pretty
That's
low,
true. That's true. It should be the cost of like the food.
what they get, yeah.
And then the next question is, if the ticket price is less than 75, we don't have to do it. Is that correct?
It looks like technically it's not required and you won't get penalized for it, but I would still do it. I would not leave a gray area there. Do you agree, Diana? I think.
Yes.
Okay.
Like, for example, I just wrote a $25 check for something, and I got a thank you and an acknowledgement. So I think best practice is you thank everybody.
Right. I mean, it's good to know what the rules are, and the organization would be penalized if they didn't do it for a $75 and above one. But it's also good to know that if you forgot and it was a $25 one, you're not going to be penalized by the IRS. Okay. Moving on. So we talked about pledges, grants. If you have funding sources like from foundations or corporations where they're giving you money as a result of a grant proposal, a lot of times you're given the money up front, which are the best kind of grants to get. And you would record it as long as there are no conditions that we talked about. There could be restrictions or it could be without restriction, but as long as there's not a condition, then that becomes revenue when you receive it. Like we talked about again, a multi-year grant, you would recognize the entire grant as revenue at the time the grant is awarded, assuming no conditions are on it. A cost reimbursement is a good example of this. Common when you're receiving grants from the government, and you know, it's based on when you expend eligible expenses. So I'm not going to go into too much detail about that, but generally, if you expend the expenses, you might have a receivable because you met you've earned it. So you would record revenue at that time. And then in reverse, if you receive the money up front on a cost reimbursement grant, you might have a liability, which would be something like refundable advances. So once you earn the revenue against it, you would be able to recognize it and relieve that liability. It could get pretty complicated. So that's when you need someone like Bookminders. So the refundable advance, is an advance payment. It's received in advance and of when the condition, before the condition is met. So when the condition is met, you would use the liability to bring down the liability equal to the amount of the revenue that you're earning. All right, statement of financial activities expenses. What are expenses and how and when do we record expenses? This is much easier than revenue for a nonprofit. So the expenses are the money spent or cost incurred in an organization's effort to generate revenue. So it could be actual cash payments. It could be a credit card payment or charge. It could be the calculated expired portion of an asset, like we talked about with depreciation, or it could be an amount that you take out of earnings, such as bad debt. Sometimes if you have pledges, you might have a history of how many pledges actually do not get recorded or do not get collected, and your auditor will probably ask you to have an allowance for bad debt, and that would be an expense. So nonprofit organizations are required to track expenses by two ways: by natural classification, which would be the account balance, like payroll, legal expense, supplies, and then also by functional classification, which would be how you're using that money in fundraising, general and administrative costs, or by program costs. So these functional categories need to be tracked. The way we do it with our clients is in QuickBooks. If you're using QuickBooks, we use the class tracking for your functional expenses, and then we just use the general ledger chart of accounts for your natural expenses. So if you're getting an audit, and your 990 requires functional expenses reporting as well. So an audit or 990 would require that you do this. If you're not tracking it during the year, a lot of people will just look at your expenses and get a reasonable allocation at year end, but it's really best to keep track of it during the year. So every expense will fall into functional categories. You might need to allocate, like a rent expense, you might allocate among your different programs and also among fundraising and general and administrative, but every expense will be somewhere on your functional expenses. Like I said, we use classes in QuickBooks to produce a statement of financial activities by class, and that gives you your statement of functional expenses. So an example of a class list and your different functions might be, you would have a header account for support services, and under that you'd have your admin and your fundraising, and then you'd have another header account for all of your programs, and then you would list your programs under that. So in this example, we have Head Start and an arts program. So then when we do the statement of activity by class, your columns are now going to be your functional expenses. So you'll see we have this blue outline is now your statement of functional expenses. It shows your expenses in total by natural classification. So we have 23,900 of payroll expenses, but then we're also seeing you have 15,000 total of expenses for admin, 7,750 total for fundraising, and 16,650 for programs. So this is how you would display your statement of functional expenses, showing your expenses both by your GL account or natural classification and by your functional classification with the columns across the top. So in addition to class tracking, which gives you your functional allocations and of expenses, in QuickBooks, we use customers and jobs to be able to track your funding sources so that if you needed to give a grant report to a specific funding source, we would be able to do a statement of activities by funding source rather than a statement of activities by class. And then we could even track over multiple years. So you can make that based on your grant year to show them all the revenue and all the expenses that came in for specific grants that you're tracking. So an example of a job list or customer job list where you would show your funding sources, we have two big header accounts. One of them is your net assets without donor restriction. And then the other one is your net assets with donor restriction. Because we said before that we need to track those net assets in those two major categories. So we're going to want to have those totals at the end of the year. So under without donor restriction, you would list all of your funding sources that you have grants with no donor restriction. And then the same with your net assets with donor restriction. Those would be your grants where they do give you restrictions. So the statement of activity or income statement by job now shows us again, natural classification of revenues and expenses, but then across the top, we have our funding sources. So this way we can see for this grant here, we wound up, for this grant, the $10,000 came in this year, and then we spent 6,725 of it. So our change in net assets was 3,275. This can also be used to be able to do a year, like an unspent grants report. So we get our change in net assets, and that's the bottom line. But then where does that go? That goes to your balance sheet. So your beginning net assets were 20,195, and then the change in net assets for that period is 1,600. And that's how we get to our total net assets. So assets minus liabilities is your net worth or your net assets. So assets on the balance sheet are any item or a value that is owned by the nonprofit that could be converted to cash. And then on the flip side, liabilities are any obligation that could result in a loss of an asset. So your net assets is that equity of the organization. So it represents either your unspent or overspent balances of the funds provided. On the left side, if you're using QuickBooks, this might be what your balance sheet looks like. And then on the right side for your audit report, it's pretty similar. The only difference is down here at the bottom where we're kind of keeping track of total net assets. On the audit report, remember, we already know because we're tracking them separately what our net assets without restriction and net assets with restriction are. So we're doing a little more detail of this, but this is how it shows up on the audit report. So we have a net asset balances report because we're tracking it by funding source. So each month we're able to monitor our restricted assets and even our unrestricted assets if we're tracking it at that level. And we need this for the GAAP, the Financial Accounting Standards Board disclosure requirement in your audit report. So this is the QuickBooks report that we do. We're able to tell you for these different grants, how much is left to spend. And we look at this every month. So if there's a negative here, it means we put too many expenses to a specific grant and we've overspent it. So we'll talk to our client and say, we need to reallocate expenses. We can't charge this grant anymore. We need to charge a different grant. So we use this report to really monitor activity through the year and make sure that we're not overspending on a grant. But then this report is also used by your audit firm to be able to get the details that they need to put on the balance sheet and in the footnotes to the financial statements. So the next few slides are some tools that you can use to measure performance, measure your liquidity, and they are good things to know at a specific point in time. But in reality, you may want to just kind of monitor them and see how they change from month to month or quarter to quarter or year to year to really understand, like, are there certain times a year where your cash flow is too low, and what should we do to kind of account for that, make sure that we're good and things like that. So the current ratio is you calculate it by taking your current assets minus any cash that's restricted by donors or other restrictions, and then divide it by your current liabilities. So the higher the ratio on this means the more liquid you are. And generally a healthy organization will have a current ratio of at least 1. Now you may want to consider increasing liquidity by moving some funds to higher yielding accounts that are still liquid and ready to use. But it's really good to reevaluate your asset mix, especially when interest rates are changing, which we see that we got a nice big interest. We got an increase yesterday, so it might be a good time to take a look and see if you have an account that has a checking and a savings component, like what is your interest rate on that savings account? And does the bank have another product that might be a better place to put it, like a money market, so you can earn more interest and become even more liquid. This is the restricted asset ratio, and it tells you if you're borrowing from the future or from net assets that are intended for future periods. We do cash and we add in the accounts receivable, and then you divide it by the net assets with donor restrictions. So if that ratio is below 1, it means that the organization is borrowing from the future and doesn't have the money to perform the promised actions in those restricted donations. Cash on hand tells you how many days the organization can pay for expenses without receiving additional revenue. And this is the calculation for it. So organizations typically strive to maintain at least 90 to 180 days cash on hand. High end would be 2 years of your budget, and the low end would be enough to cover 1 month of your budget. And this is functional expense allocation. This is something that's really subjective. You really want to be comparing your organizations to other organizations that are similar to you. And it could change from year to year based on what your board priorities are for a given year. But basically, it tells you by using those functional expense categories, what percent of your expenditures are going towards programs, what percent is going towards fundraising, and what expense is going to your overhead. So generally, the reasonable allocations you really want to have is more in programs, 15 to 20% in admin, and usually the lowest in fundraising. But really, it kind of depends on what's going on. If you have a capital campaign going on, your fundraising needs to be higher. If you are, bringing on a new IT infrastructure, you're going to have more consultant expenses that might fall under admin. To the extent that you can allocate some of those expenses to program, you should, and that's something you would talk with your auditor about and see how much you could reasonably allocate to the programs. So that is it. Are there any more questions?
Nothing new has come up yet.
Okay.
This is a quiet group compared to Monday.
Yeah.
Okay, Paulette, do you want to talk a little bit about?
Yeah. So, we just wanted to make sure that, this follows with all the compliance, with your 990s and your balance sheets and all of those things. The matrix also helps with planning for all of those items. And if you need any help with anything, please always reach out to us. We are here to help you. I know we were talking, like someone was asking if maybe we could help them one-on-one with some of these kinds of things. I don't know if Bookminders is a resource for that. Or, you know, moving forward, we're definitely adding more things to the tools to help out with all of this stuff as well.
I would say if you have questions about the record keeping and generally accepted accounting principles and things like that, definitely reach out. You can use my contact information, which I think is in the presentation. But as far as like tax work and specifics to you for like decisions about allocations and things like that, if you have an auditor or a tax person, we always kind of refer back to them to get the best advice as far as stuff like that.
All right, Diana, do you want to add anything and wrap us up?
Again, any questions, we're going to be in touch shortly, through the RDs as part of compliance is to really help you look at, you know, how you're doing and what you're doing. I think the two biggest things that we want you to leave today with is number one, that everybody should be, no one should be on a cash basis. Everybody should be on an accrual basis. And that we need to make sure that we are setting up procedures and policies to protect the assets of the organization. We do have a sample, you know, some of the affiliates have talked about having 2 people sign checks. There are ways to get around that, as long as you have one person approving checks versus someone who's actually producing the check. So the RDs are going to be in touch. We'll be working with all of you. But in the meantime, if you have any questions, don't hesitate to give us a call. With that, anybody else have any comments, questions? Okay. Well, I hope everyone has a great afternoon. Thank you.
Everybody.
Thank you. Thanks.